Hi guys, welcome back to Tax Q&A. Every now and then we come across headlines like these, and then there's this number. Over 3,000 startup employees made more than rupees 1,450 crores from ESOP buybacks in 2024 alone. So, are people really becoming crore-patis from jobs? Well, if you bet on the right company, you might. See, getting ESOPs is not very difficult these days, especially with startups. A survey shows that 78% of startups now offer ESOPs. And it's not just that. Today, 90% of startup founders actively talk about ESOPs during job interviews. Clearly, ESOPs have gone from becoming an HR jargon to something everyone wants to understand. And let's be honest, get maximum value out of it. So today, let's look at some of the most asked questions about ESOPs and understand them in detail. Employee Stock Ownership Plans, or ESOPs, are like a reward system where companies give employees the option to own a piece of the company in the form of stocks. So instead of just receiving a salary, you get the chance to benefit directly from the company's growth. Now, companies offer ESOPs for various reasons, but primarily they help attract and retain good talent, especially in startups where cash compensation might be limited. And because employees know they have skin in the game, they naturally feel more connected to the company's goals and growth. In short, ESOPs create a win-win scenario. Companies get committed, long-term talent, and employees get a share in the company's success. When you hear the word shares, you probably think of buying them in the stock market. But ESOPs are a little different. See, with ESOPs, the company grants you the right to buy shares in the future, usually at a pre-decided price. Now, once you decide to use that right, what's called exercising your ESOPs and actually buy those shares, they start functioning just like regular shares. You can sell them or hold them for longer. Your choice. Yes, they are. CTC, or cost to company, is basically the total amount a company spends on you as an employee. And since ESOPs are a form of compensation, they're usually included in your CTC. However, they aren't cash components like your monthly salary or annual bonus. ESOPs represent the right to buy company shares at a predetermined price in the future, and their value depends on how the company performs over time. So, while they are factored into your CTC, their actual financial benefit will only materialize when you exercise them and potentially sell the shares later. Alright, for this one, let's take an example. Say there's a company called ABC Private Limited. They decide to set aside a portion of their shares, let's say 10% of the total shareholding, to create something called an ESOP pool. Now, when you join ABC or hit certain milestones, the company grants you ESOPs. Let's assume 1,000 ESOPs. At this point, these aren't actual shares. They're more like a promise that you can buy 1,000 shares of ABC in the future at a fixed price. Let's say rupees 100 per share. This price is called the exercise price. But there's a catch. ABC isn't going to give you all 1,000 ESOPs on day one. They want you to stay and contribute to the company's growth over time. So they set a vesting period. For example, ABC says, we'll give you these 1,000 shares over 4 years, 250 each year. This way, every year a portion of your ESOPs becomes available for you to exercise, and the longer you stay, the more ESOPs you unlock. And finally, once your ESOPs are vested, you have the right to pay the exercise price and buy those shares. At this stage, you officially own the shares. And if the company grows, those shares could become significantly more valuable. Alright, this is very important. You should know whether those ESOPs are worth getting a cut on the cash component and other incentives of your salary. First, it's crucial to look at the company's financial health. Is the company making profits? Are they planning to raise funds? What is their 5-year roadmap? These are some key questions you'll need to ask because ESOPs are only valuable if the company performs well over time. Also, if you're joining an early stage startup, the potential upside might be higher because the company is still in its growth phase. but that also comes with more risk and uncertainty. On the other hand, in a late-stage startup or an established company, the growth might be more predictable, but the upside may not be as dramatic. Next, pay close attention to the vesting schedule and exercise price. These two factors directly impact when you benefit from your ESOPs and how much they'll cost you. A longer vesting period means it will take more time for you to fully unlock your options. And when it comes to the exercise price, the lower it is, the better. Another important factor is understanding how ESOPs compare to other forms of compensation. If you're being offered ESOPs in place of a higher salary or bigger bonuses, you'll need to carefully consider the trade-off. ESOPs can lead to significant financial rewards, but they're not cash in hand. They depend entirely on the company's growth and are often not liquid immediately. Speaking of liquidity, you should also try to know about potential exit opportunities. Does the company conduct ESOP buyback programs regularly, or is there a clear path towards an IPO or acquisition? Without one of these events, you might end up holding valuable shares on paper but have no real way to sell them for actual cash. See, at the end of the day, ESOPs are equity in a company, and equity means high risk, especially with only 1 in 10 startups actually making it big. So, if you have the option to negotiate cash in hand versus ESOPs, I would personally get to a comfortable salary first early on in my career. And in case ESOPs are an added perk over and above your cash component, good. But even then, you shouldn't see them as your only ticket to becoming rich in life. I look at ESOPs as an investment in the company. And like any investment, ESOPs are neither right nor wrong. So rationally evaluate the company's business, competitive advantages, risks, and do what's right for you. Once your ESOPs have vested, you can't hold on to them forever without taking action. You have a specific period during which you can decide to pay the exercise price and convert your ESOPs into actual shares. This is called exercise period. The exercise period may differ from one company to another. The exact timeline depends on the company's policy and is mentioned in your ESOP grant letter or agreement. Yes, like we already discussed, the price at which you can buy the ESOPs is known as the exercise price, and it's usually lower than the market value of the share. You need to pay this amount when you decide to exercise your rights. For example, if you had 1000 ESOPs and the exercise price was Rs 100 per share, you would need to pay Rs 1 lakh to buy those shares. Once you pay this amount, those ESOPs are converted into actual shares in your name. When a company goes public through an IPO, it means its shares are now listed on the stock market and can be freely bought and sold. If your ESOPs are vested and exercised before the IPO, you already own the shares. So, once the company goes public, you can sell those shares at the market price. However, some companies might impose a lock-in period, typically 6 months after the IPO, during which employees cannot sell their shares. In case your ESOPs are vested but not yet exercised, you will have the option to exercise them and then sell them at the market price. This depends on the stage your ESOPs are in when you leave the company. For vested ESOPs, you'll usually have a limited window of time to exercise them, depending on your company's policy. Some companies even have an exercise period as short as 30 days, while some others allow you the option of a lifetime. However, if there's a limited exercise period and you don't exercise them within this period, your ESOPs will lapse. Then there are your unvested ESOPs, the options you haven't earned yet because they're still logged in the vesting period. These unvested ESOPs are forfeited when you leave the company. They simply go back to the company's ESOP pool and are no longer yours. Because there are multiple stages in the ESOP process, taxation also happens in stages. Once at the time of exercise. This is the point when you actually buy the shares. At this stage, the difference between the exercise price and the current market value of the shares is considered taxable income and is taxed as income from salary. For example, the company grants you 1000 shares with an exercise price of Rs 100 per share. At the time of exercising, the fair market value of each share is rupees 300. The difference of rupees 200 per share becomes taxable. For 1000 shares, that's rupees 2 lakhs, which will be taxed as part of your salary income. The tax liability will depend on the income tax slab you fall under. Once you exercise the stock options, the shares are transferred to your demat account, and the exercise date becomes your date of acquisition, and fair market value, which is rupees 300 in this case, becomes your cost per share. Next, you pay tax when you sell the shares. When you sell your shares, the profit you make is considered a capital gain. How much tax you pay depends on whether the shares are listed or unlisted and how long you've held them after exercising. This table summarizes the tax rates for both of these cases. Lastly, it might also happen that the company does a buyback and you sell your shares then. In that case, the entire amount you receive is taxed as income from other sources at your applicable slab rate, and later on you can claim the cost of acquisition as a capital loss. We've covered this in detail in our tax Q&A thread. Check the link in description. This does become an important question if you're working for global giants like Google, Microsoft, or Amazon, or even smaller startups headquartered abroad. Now, while the basic structure of ESOPs remains the same, grant, vesting, exercising, and sale, one thing that changes is the taxation. At the time of exercise, the tax rules remain the same as domestic ESOPs. The difference between the exercise price and the fair market value is taxed as salary income in India. However, when you sell the shares, they are taxed as foreign shares. The tax rate will be 12.5% for long-term gains and slab rate for short-term. Moreover, if you hold ESOPs from a foreign company, you must declare them in your ITR under the Foreign Assets Schedule. And with that, it's a wrap. If Google search is too much work for you, Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one.